Welcome to a world where investing wisdom meets simplicity. Today we venture into the realm of dividend ETFs, focusing on SCHD, DGRO, and VYM. Ever wondered what dividend ETFs are? They're exchange-traded funds that primarily invest in companies issuing dividends, which are a portion of a company's earnings returned to shareholders. These ETFs are a popular choice among investors seeking income and stability in their portfolio, thanks to their potential for regular income and capital appreciation. Now imagine a trio of dividend ETFs, SCHD, DGRO, and VYM, each with their unique characteristics and strengths. SCHD focuses on U.S. dividend stocks, DGRO emphasizes dividend growth, and VYM pursues high yield. All three are powerhouses in their own right, but how do they stack up against each other? That's what we're here to find out. So buckle up as we dive into the intricate world of these three ETFs. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. Our first contender in the ring is SCHD. This heavyweight has been a favorite among investors for years, and for good reason. The Schwab U.S. Dividend Equity ETF, or SCHD, has proven itself to be a consistent performer over the past years, making it a reliable choice for those seeking to add a dividend-focused ETF to their portfolio. SCHD's performance is not just about its impressive track record. It's about the strategy behind the ETF and how it's structured. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which includes 100 high-dividend-yielding U.S. companies with a 10-year track record of paying dividends. This careful selection aims to offer investors a diversified exposure to some of the most established and reliable dividend-paying companies. Now let's talk about fees, because we all know every penny counts. SCHD has an expense ratio of just 7 basis points. That's right, just 7 basis points. This makes it one of the most cost-effective options in the dividend ETF space. It's a prime example of how low-cost index investing can work in your favor. One of the key factors that sets SCHD apart from other dividend ETFs is its sector exposure. The ETF has a significant allocation to the technology sector, which includes some of the largest and most profitable companies in the world. This can be an attractive feature for investors who want to combine the growth potential of tech stocks with the reliable income stream of dividends. Let's not forget about the holdings. SCHD's top holdings include blue-chip companies that have been around for decades. These are companies that have proven their resilience in various market conditions and have a history of rewarding their shareholders with regular dividend payments. In conclusion, SCHD combines the benefits of dividend investing with the advantages of a low-cost ETF. It offers a diversified exposure to established high-dividend yielding companies, and its low fees make it an attractive choice for cost-conscious investors. SCHD certainly has its highlights, but how does it stack up against DGRO and VYM? Let's find out. Next up, we have DGRO, another heavyweight in the dividend ETF arena. The iShares Core Dividend Growth ETF, or DGRO for short, is one not to be overlooked. This ETF is all about companies that have a history of sustained dividend growth. It's a strategy that has proven successful over time, and DGRO has been a key player in this space. Let's dive into the performance of DGRO. Over the past 5 years, this ETF has shown steady growth, outpacing many of its peers in the dividend ETF sector. It's not just about the past, though. DGRO's future prospects also look promising, with analysts predicting continued growth based on its robust portfolio. Speaking of the portfolio, DGRO's holdings are a mix of large and mid-cap companies across a variety of sectors. This diversification adds to its appeal, providing a level of protection against market volatility. The top sectors in DGRO's portfolio include technology, healthcare, and consumer discretionary, reflecting the growth-oriented approach of this ETF. Now let's talk about fees. DGRO has an expense ratio of just 8 basis points. That's pretty competitive in the ETF world where every basis point counts. It means more of your investment stays in your pocket, which is always a good thing. Another key factor to consider is DGRO's dividend yield. It's currently hovering around the 2.5% mark. While this may not be the highest yield in the dividend ETF arena, it's the consistency of this yield that's impressive. DGRO focuses on companies that don't just pay dividends but grow them over time, creating a snowball effect for your investment. DGRO has shown its prowess, but is it enough to outshine SCHD and VYM? Stay tuned. As we move forward, We'll delve into VYM and then draw comparisons among these three dividend ETF powerhouses. It's a matchup that's sure to spark some interesting discussions. So don't go away. There's plenty more to uncover in the world of dividend ETFs. Last but not least, we turn our spotlight to VYM. The Vanguard High Dividend Yield ETF, or VYM for short, is another popular choice among investors seeking steady income. This fund is managed by Vanguard, one of the most trusted names in the world of investing. VYM is an index fund that aims to track the performance of the FTSE High Dividend Yield Index. This index is comprised of companies that are characterized by higher than average dividend yields. The fund's approach is to invest in a broad range of U.S. stocks that are expected to provide a steady stream of income to its investors. Over the years, VYM has shown a commendable performance. Its returns have been consistent, providing investors with a reliable source of income. The fund has a solid track record, demonstrating its ability to generate returns in a variety of market conditions. A key aspect to consider with VYM is its low expense ratio. The fund charges a minimal fee of 0.08%, which is quite competitive in the ETF landscape. This low fee structure allows more of your investment to work for you, rather than being eaten up by costs. VYM's holdings are diverse, covering a wide array of sectors. This diversification reduces the risk associated with investing in a single sector and provides exposure to various segments of the economy. The fund's largest sector allocations are in financials, healthcare, and consumer services. Lastly, it's important to note that VYM follows a passively managed investment strategy. This means the fund's holdings are not actively selected by a fund manager, but are instead determined by the underlying index. This approach is designed to minimize costs and closely mirror the performance of the index. In a nutshell, VYM offers a low-cost, diversified exposure to high dividend-yielding U.S. stocks. Its consistent performance and low fees make it a strong contender for those seeking steady income from their investments. With VYM's characteristics laid bare, we are set to delve into a head-to-head comparison of these three dividend ETFs. Now that we've dissected each ETF, it's time to see how they fare against each other. Let's start with performance. Over the past 5 years, SCHD, DGRO, and VYM have all demonstrated strong growth. SCHD, the Schwab U.S. Dividend Equity ETF, has outperformed its peers, showing a steady upward trajectory. This is due in part to its focus on high dividend yield stocks, which have been doing well in the current market environment. In comparison, DGRO, the iShares Core Dividend Growth ETF, has shown a more moderate growth pattern. This is reflective of its investment strategy, which prioritizes companies with a history of sustained dividend growth over those with high current yields. VYM, the Vanguard High Dividend Yield ETF, has shown a similar growth pattern to DGRO. However, its focus on high-yielding stocks has allowed it to edge out DGRO in terms of total returns. Now let's look at fees. SCHD has an expense ratio of 0.06%, making it the cheapest of the three. DGRO and VYM, on the other hand, have expense ratios of 0.08% and 0.06% respectively. While these differences may seem minuscule, they can add up over time, particularly for long-term investors. In terms of other key factors, SCHD's focus on high-yielding stocks means it has a higher dividend yield than DGRO and VYM. However, this also means it's more exposed to the volatility of these stocks. DGRO, with its emphasis on dividend growth, offers a lower yield but potentially more stability. VYM, meanwhile, offers a balance of yield and stability, thanks to its broad coverage of the high-yielding stock market. Let's highlight the strengths of each ETF. SCHD's strength lies in its high yield and low cost. It's an attractive option for investors seeking immediate income. DGRO's strength lies in its focus on dividend growth, which may appeal to investors looking for long-term income growth. VYM's strength lies in its broad market coverage, which provides diversification and potential stability. As for weaknesses, SCHD's focus on high-yield stocks could make it more volatile and potentially riskier. DGRO's focus on dividend growth means it may underperform in a market that favors high-yield stocks. And while VYM's broad market coverage reduces its exposure to any single stock, it also means it may miss out on the high returns of more concentrated ETFs. In conclusion, each ETF presents a unique blend of opportunities and risks. SCHD offers high yield and low cost but comes with potential volatility. DGRO provides steady dividend growth but may not be the best fit in a high-yield market. VYM provides broad market exposure but may miss out on the returns of more concentrated ETFs. As we can see, each ETF has its own unique edge and potential pitfalls. With careful consideration and a clear understanding of your investment goals, you can decide which of these ETFs, SCHD, DGRO, or VYM makes the most sense for your portfolio. So we've journeyed through the landscapes of SCHD, DGRO, and VYM, but what does this all mean for you as an investor? It's a question that's as important as any we've explored today. We've delved into the intricacies of these three dividend ETFs, each with its unique features and strengths. Let's take a moment to revisit the salient points. The Schwab U.S. Dividend Equity ETF, or SCHD, is a standout choice for those seeking a blend of value and quality. It offers exposure to high dividend-yielding U.S. stocks with a proven record of consistency in paying dividends. This ETF is an excellent choice for investors who appreciate stability and reliability. Then there's the iShares Core Dividend Growth ETF, DGRO. This ETF is designed for the investor who values a balance of growth and income. It specifically targets companies that have a history of sustainable dividend growth, making it an attractive option for those with a long-term investment horizon. And lastly, the Vanguard High Dividend Yield ETF, VYM. This ETF offers exposure to U.S. companies with higher-than-average dividend yields. This can be a suitable choice for those seeking a higher income stream from their investments. But remember, it might come with a bit more risk. But as we've said, there's no one-size-fits-all answer here. The perfect dividend ETF for you depends on your individual investment goals and risk tolerance. If you're a more conservative investor seeking a steady income stream, SCHD might be your go-to. If you're looking for a balance of growth and income, DGRO might be more up your alley. And if you're willing to take on a bit more risk for the potential of higher returns, VYM could be your choice. Don't forget about the fees. While they might seem small at first glance, over the long haul, they can significantly impact your returns. So always factor in the expense ratio when making your decision. In conclusion, the key to successful investing in dividend ETFs is understanding your financial goals, knowing your risk tolerance, and aligning these with the right ETF. It's not about chasing the highest yield or jumping on the latest trend. Instead, it's about making informed decisions that align with your unique investment profile. So before you dive in, take some time, reflect on your investment goals, consider your risk tolerance, do your due diligence, and remember, the journey of investing is a marathon, not a sprint. It's about steady progress over time, not quick wins. Remember, the perfect dividend ETF doesn't exist. It's all about finding the one that fits your investment profile like a glove. As we wrap up this deep dive into dividend ETFs, we hope you've gained valuable insights. The journey into the world of investing is long and winding, but every step you take is a step towards financial freedom. Remember, the key is not just about investing, but investing smart. Consider the points we've discussed today when choosing your dividend ETFs. SCHD, DGRO, and VYM each have their own unique offerings that cater to different investor needs. Don't stop here. Continue learning, continue exploring. The more you know, the better your decisions will be. And remember, fees matter. They may seem small, but over time they can significantly impact your returns. Investing is not a race, it's a marathon. It requires patience, discipline, and knowledge. So equip yourself with these tools and embark on this exciting journey. If you found this video helpful, do subscribe, like, and share. Stay tuned for more investing wisdom. Until next time, keep investing smart.